Okay, so good morning, everyone. Welcome to the Macro Snapshot. We are Wednesday, August the 20th, 2025, recording this in the morning as always. I just want to have a look at the New Zealand dollar here. This is the three-minute chart, so very short term, but you can see here a huge fall over 1% last night when the Reserve Bank of New Zealand made its interest rate decision. I just want to focus on that for a minute or two here. It's kind of interesting because the RBNZ, they cut 25 basis points as was completely expected, but they did say that they debated very seriously a 50 basis point cut, so much more dovish and a much more dramatic cut. In fact, out of the 6 committee members, 2 people actually voted for the 50 basis point cut. So a very dovish 25 basis points cut. And what's interesting about that is that in the statement and the sort of the analysis, the bank noted that there was a lot of slack in the labor market. There was also a lot of sort of underproduction, underutilization of capacity, sort of in the business environment, in the production environment. And they also sort of doing all of that. The fact that the New Zealand dollar came down so much also pushed down the yields a lot. And so the terminal rate is now down about 20 basis points compared to where it was. And if we actually just look here, just on the Bloomberg function here, you can see that for New Zealand, the Reserve Bank of New Zealand, you can see that still number of cuts, still another 2 cuts are sort of being priced by the market by May of next year. And you can see now that they're now down to about 3% or 3.25% to be precise about it. So there's still the market saying that, the terminal rate will get down to about 2.5% or so. So still a little more cutting to be going. And what's interesting there is that the Reserve Bank of New Zealand acknowledged the fact that inflation was kind of sticky, that the CPI might actually continue to rise a little bit to the top of their their target range. Now, keep in mind that in New Zealand, they have a target range of inflation of 1 to 3%. So what's interesting to me is that they acknowledge that the CPI actually might get to the top of that range, but rather than being sort of aggressively, let's say sort of hiking or not cutting, not only did they cut, but there was a reasonable chance of cutting 50 basis points. And the logic in the statement was that yes, they believe that inflation was rising, could rise a little bit more, but gradually with this sort of slack in the labor market and slack in production and industrial capacity, gradually sort of output would reduce and therefore economic activity would actually stagnate a little bit, which would cause us a deflationary pressures. And so they believed that their inflation would eventually sort of come down. And this is in the context that the unemployment rate in New Zealand is now about 5.2%, so 5.2%. But compare that to 3 years ago, where it was 3.2%. So in the last 3 years, it's gone up about 2%. And so, another quote from the statement I've got here is that the tariff uncertainty as well will depress business investments, and therefore rate cuts could also be less effective. So part of the logic, it's interesting logic here potentially for other central banks, is that they're saying that, even if they're cutting interest rates, it's got to be less stimulatory than, let's say, the typical situation or the historical situation as it's been, because the tariff uncertainty is still basically preventing businesses from investing, which is depressing activity. So if we sort of step back a little bit, and the reason I'm focusing on New Zealand, which is a small economy, is that this logic is similar, not exactly the same situation faced by, let's say, the Bank of England or the Fed. Both of these countries have a lot less labor market slack. Let's be absolutely honest. The unemployment rate in the US is not 5.2%. It's more like 4.1 or 4.2%. So definitely a much tighter labor market, and industrial and production capacity is not as underutilized as, let's say, New Zealand. So definitely New Zealand is starting with a weaker economy. Having said all that, I think it's interesting to look at their logic as sort of clearly spelt out in the statement by the New Zealanders, and think about something like the BOE or the Fed, which is also facing sort of sticky inflation. And rather than saying, well, hey, inflation is a bit sticky, we're never going to cut, they could really just focus more on their labor market or employment mandate and sort of say, well, even if we do cut a little bit, there's still tariff uncertainties. Businesses are sort of putting off their plans for capital expenditure and investment. and that as soon as we get a little bit of the effects of that and labor's and the economy slowing down a little bit, we could have a weakening sort of labor market, which would be deflationary and would require further rate cuts and stimulation. So kind of interesting to look at that and spend just a couple of minutes thinking about the logic, if nothing else, of the New Zealand central bank there, and cutting 25 basis points and considering the 50 basis point cut. And the point also, just from in terms of a trading perspective, you see here that when the market is a little bit surprised by something which is more dovish, there's plenty of room to move. And we can see here that about 60, 70 ticks or so of the New Zealand dollar was down about 1% on the day. So plenty of room to move there. And just putting it on the daily chart, you can see here that that was quite a strong move. And it looks as though the Kiwi, the New Zealand dollar, is heading downwards. So the point is that obviously we don't really have too much data today or over the next couple of days. And the big one everyone's essentially sort of treading water for and waiting is obviously Jackson Hole's speech of Powell on Friday in a couple of days at 10 a.m. So the question there, I think there's really a room for a lot of movement here, because he could err on this sort of or go towards this more dovish sort of logic, which we just saw from the Reserve Bank of New Zealand, and essentially say that yes, inflation was a bit sticky, but they're seeing some sort of signs of stagnation in sort of capital expenditure, investment. Companies are not really hiring people, they're not firing people, but the labor market is sort of stagnating a little bit, and therefore a couple of preemptive cuts would be could be sort of a reasonable idea. That's one logic, and that could really sort of weaken the US dollar, strengthen gold, strengthen the front end of the curve. On the other hand, it's fairly binary, because Powell could actually essentially stick to his guns and say no, there's not significant evidence of significant sort of slowing in either the labor market or the general economy. The Fed has to remain independent. Inflation is around maybe, let's say, 2.8, 2.93%, well above their target. Remember that something like New Zealand, they have a target range of 1 to 3%, so a little bit more flexibility, whereas ostensibly the Fed does have a hard target of 2%. So it's going to be quite interesting, because I think there's really some binary outcomes here, and we'll look at that maybe tomorrow and Friday, of course, as we get closer to that speech. But there's still plenty of possibilities of sort of binary action. The other thing we get today, we get at 2 p.m., we get the minutes from the last Fed meeting. So I'm pretty sure it's at 2 p.m. Normally it's at 2 p.m. So yeah, let's have a look. Yeah, that's coming out at 2 p.m. Today. We have the Fed minutes, and that could be interesting. I mean, that's going to be slightly old news, because that Fed meeting was before the famous revisions on August the 1st to the job numbers. But what could be interesting, remember we had two dissenters at that Fed meeting. We had Waller and Michelle Bowman, who dissented and actually did vote for a cut. And of course, they're on the short list of sort of candidates to succeed Powell. So it could be interesting. We might get a little bit more sort of detail and color from Bowman and Waller, essentially telling us why they sort of dissented. That could be kind of interesting. So let's think about this. Talking about Fed and Fed candidates, we're also getting David Zervos here, who's chief sort of market strategist for Jefferies, the brokers. And you see Zervos here, he's giving an interview here. Full employment may be lower than 3.5%. Okay, so that's interesting here. Full employment may be lower than 3.5%. So the implication there is saying that even 4%, they need to be stimulatory and maybe cut a little bit. Again, this is a justification for cutting and stimulating the economy, saying that the Fed mandate. So this is interesting, twisting the logic. Well, I didn't say twisting the logic, but basically taking the logic, one of the mandates of the Fed for full employment, and saying, well, it's not 4% where it's now, or 4.1%. No, it's actually 3.5%. Now, I know that historically 3.5% is super, super, super duper. That's basically the best ever. So it's interesting that Zervos's logic here, essentially justifying maybe tweaking the Fed's interest rates lower to achieve even more employment. What else has Zervos been saying at this interview? More than excited to use Fed tools if become needed. More than excited. Okay. Wouldn't overemphasize Fed's September meeting. Fed more restrictive than thought during the balance sheet. Okay, so that's interesting. Again, saying that they are more restrictive, because someone like Powell, for example, is saying they're only moderately or modestly restrictive and not really slowing down the economy. Whereas Zervos, obviously trying to appeal to Trump, and Besant saying the Fed is more restrictive, and therefore they need to be a bit more accommodative. So the point is that quite a lot of politics, all of these people, I believe there's now 10 or 11 potential candidates on that sort of long short list, so to speak, to take over from the Fed. So they're all coming out. And it's an interesting tactic by Trump and Besant because by dragging out this process or pre-announcing this process of all the different candidates, it's almost forcing the candidates to be almost like a shadow committee or shadow sort of board of governors and it constantly coming out, as we're seeing with David Zervos here, and sort of talking on TV, giving interviews, tweeting, giving speeches, essentially putting the pressure on the Fed to cut. So almost like this shadow board. Interesting. Okay, so getting back to other stuff, as you see, not really any sort of data today. But what we did see yesterday was quite a lot of weakness, well, relative weakness in the stocks in the Nasdaq, and some people. So if you look here, if we look at the let's say the ES, you can see that that was down a little bit, but you go across to the Nasdaq, obviously tech heavy, had a bit of a solid day down. And if you actually look at the Mag sevens, that ETF MAGS Mags, you can see had a pretty big down day, and that also looks pre-market down a little bit as well. And some commentators were saying, that can be attributed to an article which was published yesterday in the Financial Times newspaper, which essentially came up with this number that 95% of businesses were getting zero return from their investments in AI products or AI sort of technology and platforms. So essentially pouring some cold water on this sort of magic bullet that, AI, if everyone starts using AI, productivity will go up, and basically undermining some of the logic for some of these higher valuations in the tech sector. And so, as we see here, the Mag 7's down and the Nasdaq's down. Is that just sort of a little bit of a blip? Also yesterday, we did see Meta, Zuckerberg, basically reorganizing his AI sort of units, reshuffling sort of team members and whatnot. So, a little bit of nervousness. There's a lot of money, a lot of capital expenditures happening in terms of the so-called build out for AI. And any sort of, how can I say, narrative or news or analysis which might prick that bubble, that sort of feel-good bubble. We do have very high valuations for a lot of these tech companies, the AI sort of sector, shall we say, and there could definitely be room for that to sort of deflate the bubble a little bit, if indeed it is a bubble. So again, though, but technically looking at the chart, no damage done. If you look, at something like the EMAs, I mean, we're still, just barely breached the 20-day EMA, still a long way above the 50-day EMAs and miles away from the 100 or the 200 EMA. So this is still very much a strong uptrend. There's no real technical damage done here. I mean, the real technical damage, you could argue that down here at 22 3/4 on the NASDAQ would be something, but that would be a healthy correction. And even down here to something like the 22,350-ish, that level, would start to represent a breach of the 50-day down to the 100-day moving average at that point. So that would be something, but it's still a long way from there. And as I say, probably what Powell has to say on Friday, and then the data will determine the next moves. In terms of other stuff, we did get higher than expected CPI from the UK overnight. So it was interesting because I would have thought the gilts would have reacted a bit more negatively to that. But basically, the US bonds were, relatively supported. And so the gilts gapped at the open, they gapped higher at the open a little bit, then gave back a little bit. And it's possibly that we're also seeing that a little bit in the pound. You see the pound here, which I'll just bring up here a little bit. You see the pound not doing a huge amount. And that was maybe because the CPI, the core numbers weren't that bad. And a lot of the analysis was attributing the higher than expected CPI in the UK to sort of school holidays being a little bit a slightly strange date, and airfares being much higher than expected for this time of the year. And so that pushed up the CPI. Bref, all of that to say that maybe it's not something which would necessarily cause the Bank of England to be more hawkish. So that's why from the gilt markets and the pound, we didn't get too much of reaction. Just finally, guys, again, I don't want to sort of overstay my welcome today. Not a huge amount going on. Just in oil, not a huge amount happening here. Last night for the API, which is the private inventory numbers, we did get a draw in crude oil of 2.4 million, so negative 2.4 million. That was a little more of a draw than expected, which I think was around about 1.8, 1.9 million. Gasoline was a build, though, of 1 1 million, so kind of counterbalancing each other. And I mentioned that just to say, just keeping an eye on the inventory numbers and whether inventories are continuing to draw down. And we get those numbers this morning at 10:30, the official US Department of Energy numbers. So we'll keep an eye on that. Apart from that, I'm not going to say too much more. The dollar remains, I don't want to say, well, bid, is that bid? Not really. It's just really trading in a sideways range here. Not a huge amount to say. So let's leave it there for today. Tomorrow we have initial jobless claims and a bit more data. And then, of course, the market will start positioning for Powell on Friday morning, which will probably provide plenty of volatility. Thanks very much. Have a great day, and we'll continue this conversation tomorrow.